Something big is happening in the housing market right now. Prices are dropping, builders are panicking, buyer demand is falling off of a cliff, and the last time that we saw this much volatility, it didn't end well. Are we about to relive 2008? Something feels off, and in this video, I'm breaking down exactly what is going on, what caused the last crash, and whether or not we're on the edge of another one. So what's going on, guys? I'm Zaback, and I've been in real estate for over a decade. I've flipped hundreds of homes, wholesaled thousands of houses, and I've built a couple of the largest real estate companies in the nation, and I've really been watching the market like a hawk. There's a lot of noise out there, but today we're cutting through all the noise with facts, history, and real data. The 2008 housing crash wasn't just a slowdown. It was a full-blown financial system meltdown. And here's how it all started. Lenders were handing out subprime mortgages like candy, including ninja loans. No income, no job, no assets. People were buying multiple homes with 0% down just to flip them. And banks packaged these risky loans into mortgage-backed securities and sold them off as safe investments. And when home prices plateaued, defaults spiked. According to RealtyTrack, 1.3 million homes went into foreclosure in 2007, up 79% from the year before. And that number ballooned to 2.3 million in 2008. And when homeowners couldn't pay, Wall Street collapsed with them. Lehman Brothers failed, Washington Mutual collapsed, and Bear Stearns was sold for pennies. This was a housing crisis and a banking crisis all at the same time. And here's what followed. U.S. home prices dropped by 30% on average, nearly 10 million Americans lost their homes to foreclosure, and unemployment hit 10%. The stock market lost nearly $8 trillion in value, household net worth dropped by $13 trillion, and it wasn't just homeowners that felt the pain. Entire neighborhoods were decimated. Vacant homes were vandalized, property values in surrounding areas plummeted, and in cities like Las Vegas, Phoenix, and parts of Florida, you could drive through subdivisions where half the homes were in foreclosure. Banks completely froze lending, businesses couldn't borrow, and consumers couldn't spend. And it triggered a broader recession that wiped out millions of jobs across different sectors, not just real estate. And confidence in the system, gone. It took years to rebuild consumer trust in both the housing market and the economy as a whole. And it took almost a decade for housing prices and the economy to fully recover. And if you were an investor or a homeowner back then, you remember how bad it really was. So what about today? How does 2025 compare? So let's take a look at where we stand right now, starting with one of the biggest influences in the market, the Federal Reserve. Jerome Powell and the Fed have kept interest rates higher for longer than many have expected, and they've been very clear. They're not cutting until they see sustained progress on inflation. That means the cost of borrowing is still elevated, and mortgage rates hovering around 7% are a big reason why buyer activity is cooled. The Fed isn't trying to crash the housing market. They're trying to cool inflation without triggering a recession. And so far, it's been a very delicate balancing act. So where are we now in 2025? So yes, prices are softening. Yes, inventory is ticking up. And yes, demand is down because of high interest rates. But listen to the experts. Economists generally don't expect a crash in 2025. And according to Yahoo Finance, most major analysts forecast a stable year ahead. JP Morgan predicts home prices will rise by about 3% in 2025, not fall. Now let's look at the actual numbers. So according to Redbug Group, we still have a strong demand and very low supply. Inventory is around 1.1 to 1.3 million homes nationwide, which is about half of what we had in 2007. We are still underbuilt by an estimated 3.2 million homes according to Freddie Mac. Homeowners today have more than 30 trillion in tappable equity. More than 2/3 of US homeowners have at least 50% equity in their properties. Lending standards are much tighter, and the average credit score on a new mortgage today is above 740. Newsweek reports that some home builders are offering steep incentives, which might feel like 2008, but it's isolated to specific markets. In fact, a lot of agents on my team here in Arizona are seeing this firsthand. They're having showings with motivated buyers, but the feedback we're hearing is that new home builder incentives are just too good to pass up. Whether it's rate buydowns, closing cost credits, or even upgrade packages, it's tough to compete with that. This is not a credit crisis. It is a rate-driven slowdown. So let's break down the 5 major differences between now and 2008. The first is loan quality. In 2008, subprime loans were everywhere. In fact, by 2006, nearly 1 in 5 mortgages issued in the US were classified as subprime. Many of these borrowers had FICO scores below 620, and loans were often being issued without verifying income or assets. In 2025, lending is strict. The Mortgage Credit Availability Index shows credit is tighter now than it has been in decades. The average credit score for new mortgage originations is over 740, and income verification is required across the board. Equity levels is another big difference. In 2008, millions were upside down. As home values plummeted, an estimated 12 million homeowners found themselves with negative equity. In the worst hit markets like Vegas and parts of California, home values dropped over 50%, leaving people owing far more than their homes were even worth. Now in 2025, most homeowners have significant equity. And according to CoreLogic, 63% of homeowners have at least 50% equity in their home. Even if prices fall by 5 to 10%, most borrowers would remain well above water. Another huge factor was inventory and overbuilding. In 2008, there was massive oversupply from overbuilding. By the end of 2007, housing inventory peaked at over 4 million homes for sale, and builders had ramped up aggressively during the boom, flooding the market with supply just as the demand evaporated. 2025, we're still in a housing shortage. Builders are offering incentives, but we're not overbuilt. National inventory sits at around 1.1 to 1.3 million units, which is less than half of what we saw in 2008. And Freddie Mac estimates we remain short by about 3.2 million homes. And foreclosures? In 2008, 2.8 million foreclosure filings occurred in a single year, according to RealtyTrack. That's more than 1 in every 54 households. Entire neighborhoods were impacted, with cascading effects on surrounding property values. Today, foreclosures are up slightly post-COVID, but still 60% below 2019 levels. Most distressed homeowners today have enough equity to sell before facing default, preventing mass inventory dumps. In 2008, the crash triggered a deep recession. Like I said, unemployment spiked to 10%, over 8.7 million jobs were lost, and consumer spending completely collapsed. Major financial institutions like the Lehman Brothers, Bear Stearns, and Washington Mutual failed, leading to a global credit freeze. Today, inflation is moderating, unemployment is around 4.2%, and banks are well capitalized. There are no signs of a systematic collapse. Job growth remains steady, and consumer balance sheets are stronger than they were during the Great Recession. So this is a correction, not a collapse. That said, there are risks in the market, and it's important to acknowledge them clearly. Affordability is near all-time lows. The average homebuyer now needs to earn over $115,000 a year to afford the median-priced home in America, compared to just $75,000 4 years ago. Prices remain historically high in many metros, but markets like Austin, Boise, and Phoenix, which saw pandemic-era price spikes, are now seeing a little bit of sharper pullbacks. Builders are facing local oversupply issues, especially where development outpaced population growth. FHA and VA loan delinquencies are trending up, particularly among recent buyers with limited equity buffers. Rising insurance premiums and property taxes are adding a whole new layer of cost pressure in states like Florida and California. Homebuyer sentiment is extremely low. Fewer than 1 in 5 Americans think that now is a good time to buy, according to Fannie Mae. However, these risks are not systemic. They're situational. Unlike 2008, there's no ticking time bomb in mortgage lending. Banks are not over-leveraged, and the vast majority of homeowners are still on fixed-rate mortgages with solid equity positions. So we're seeing stress in the market, not a full-blown collapse. So what does this all actually mean for you? Well, if you're a buyer, don't wait for a 2008-style crash. I'm telling you, it's probably not coming. Look for value, negotiate, and think long-term. If the numbers work for you right now and you can afford it right now, then buy right now. You can always refinance later when interest rates start to come back down. If you're a seller, be realistic. This isn't 2021 or 2022. Price accordingly and your home will ultimately sell. And if you're an investor, This could be a great buying window before the next wave of appreciation. Look for cash flow positive deals and don't speculate on appreciation alone. So the bottom line is 2008 was a collapse built on fraud, speculation, and leverage. 2025 is a recalibration fueled by interest rates, affordability issues, and normalization. So look, if you got value out of the video, do me a huge favor if you haven't already. Smash that like button, subscribe if you haven't already. It would greatly help me and the channel to make more content just like this, and comment down below what you think is going to happen in the housing market in 2026, 2027, and 2028. Is Jerome Powell going to start lowering rates? What is that going to do, right? Let me know down below. I would love to hear your opinion, and I'll look forward to seeing you in the next video.